Hello, everybody, and welcome to Pillar Two training here from the United States. Let me give a brief introduction. My name is Raymond Wynman. I manage the International Tax Department at Global Tax Management, which is basically the U.S. extension of the of WTS Global here in the United States. Um, I was asked to give a brief update on Pillar Two in the U.S. and I've been part of the Pillar Two task force for the past 10 months. And Wim, every time when we get together, asks me what's happening in the U.S. and every time I have to answer, unfortunately, nothing is happening with respect to Pillar Two in the US. And you will see that it is going to be no different also today as in September of 2022. And honestly, I will not see that to be changing at this point. We'll see what that means because there is definitely some ramifications around that, and we'll go through that in the next couple of minutes. I pulled together some slides that basically will kind of walk through what that means. So what we're going to be doing is I'll give you a quick status of Pillar Two in the U.S. Then we will talk about something that did come out is the corporate alternative minimum tax. And so we'll briefly talk about that. What does that mean and whether that applies to your company or not. And then finally, we're kind of looking at it holistically, where we are pulling it all together and we look at the ordering of U.S. taxes with Pillar Two taxes and how that works together. So let's start right away with Pillar Two status. And like I mentioned, there is no U.S. new legislation that addresses Pillar Two in the U.S. The Biden administration did try with the Build Back Better Act to basically come up with the global intangible low taxed income to be calculated on a country by country basis. It did pass the House, but it never passed the Senate, and it eventually died, mainly because of two Democrats, senators that did not wanted the bigger package, including Pillar Two. There was also discussions about UTPR in a green book. The green book is basically a wish list from the administration. They did talk about UTPR, but that actually ultimately never made it in any kind of proposed legislation, and therefore nothing was addressed there. The Inflation Reduction Act of 2022 did introduce into law a 15% corporate alternative minimum tax, which we refer to as the CMT. I will talk about it in the next slide, but as you will see, it is really not a Pillar Two. It is a minimum tax that is basically just on the U.S. tax rules that they came up with, and we'll talk about that in a minute. But so, with no new legislation that addresses Pillar Two, what does that mean that we really have here in the U.S.? Well, we're guilty, as we all know, which is basically what I would call a sort of like a CFC regime type of taxation on the foreign subsidiaries. But because it's determined on a global. First of all, it's based on a global blended basis. And second, because it is taxed effectively at 10.5% tax rate, it will not conform. It's likely not to conform with the income inclusion rules on the Pillar Two. And so we'll have guilty that does not conform to IIR. And then we have the CAMT, as I just mentioned, that will also not qualify as a Pillar Two taxes. We'll go into, in the slide after this, we'll go into a little bit of what does it mean and how does this all come together. But before that, I wanted to spend a few minutes on the corporate alternative minimum tax. This is law. It's effective for tax years beginning after December 31st, 2022. And it is sort of the US way of looking at having a minimum 15% tax. But as you will see, as I'm going to walk through this, it is addressed completely differently. Mainly, first of all, so CMT is a 50 minimum tax based on adjusted financial statement income, which we'll define in a couple of bullet points later. It applies to U.S. multinationals that have a 3-year average of $1 billion in AFSI, world wealth, in world wealth AFSI. So this is income, right? $3 billion in financial statement income. We are not talking about revenue here. And so obviously, when we compare that to Pillar Two, the $750 million of 750 million euros of revenue, we are talking about a much smaller population that applies this. It does apply also to foreign multinationals that have US subsidiaries, so that is probably relevant for most of you that listen to this. But there is basically an added requirement. So you still have the 3-year average of a $1 billion in AFSI for the entire group, but then also there needs to be at least $100 million in adjusted financial statement income in the US. So what is AFSI? And again, I'm not getting into the great details here, but it basically, you start with financial statement income, and it is adjusted for dividends from entities that are not members of the group. So you might have members that are not part of the group for which you are getting dividends, and so you need to increase it for any dividends that you receive from them. And then because you're starting with the US group AFSI, you need to add in all your foreign corporations underneath. And so I just wanted to underline that, because when we'll talk about that later, we are basically saying here that there is this is not just a domestic minimum tax. This is actually also a foreign, right? So it addresses both the US and the foreign being the entities underneath the US. We need to adjust US and foreign taxes that are removed. And then there are some sort of adjustments that are basically needed in order to try to get back a little bit more to taxable income. So you do make adjustments for depreciation and pension expense on the concept that are very similar to tax, and therefore you do bring that back. Again, this is just an overview. There are many other adjustments that are in there, but just wanted to lay those out. So I have now my AFSI. Now I have the ability to basically calculate, well, what is my corporate alternative minimum tax amount? Well, that is basically the difference between, first of all, I have my AFSI worldwide that I multiply by 15%. And then I reduce that by any applicable foreign tax credits, because remember, like I said earlier, the foreign earnings are included in there, in the AFSI. And I do get a credit. For foreign taxes that are paid. There are different types. It's probably too much detail for these purposes, but there are differences between foreign tax credits that are of the liability of which is the US company versus the foreign company. The US company liability, foreign tax liability, is fully creditable, no question asked. But the foreign taxes paid by the foreign entities are going to be limited to basically the foreign AFSI times 15%. So this way, they are limiting the amount of foreign tax credit. You cannot use more than 15%, which is the minimum tax. And then you compare that to the regular US tax and the B tax, and the difference between the two is what is considered the corporate alternative minimum tax. I just wanted to point out that CAMT is basically a temporary tax. And what I mean by that is that you have the ability to, you might have to pay it in 1 year, but then it can be carried forward and applied against regular US tax in the future. So it could be just a timing. Obviously, if some companies are going to be in a permanent position where they're always going to be below 15% overall tax rate, then you might, this CAMT could become so almost like a permanent. But I would expect for most companies that there is going to be a fluctuation in the rate, and therefore there could be that they pay in 1 year and then they basically get a credit for it in the following years. On the next slide, we're going to basically mention that is going to be an issue on the Pillar Two. So let's talk about then CAMT and Pillar Two, and what does that mean? So, like I said, we do not believe that it addresses Pillar Two, CAMT, and so does the U.S. Treasury. U.S. Treasury basically has come out that it does not expect the CMT to be a qualified domestic minimum top-off tax. It's not going to be a QDMTT, and the reason is, first of all, it's not a domestic top-off tax, but it's a global top-off tax. And then, as you can see from the calculations that I was going through before, this is done based on a global blended basis. So if I might pay enough tax in the US, and then I have a Cayman company where I pay zero tax, and I pay in Germany I might be paying 30%. I have the ability of combining them together and maybe still not owe taxes, because it's a blended basis between Germany and Cayman in my example, and I still do not owe any taxes under even the CAMT. So that is why that's why Treasury, and we believe that this probably does not qualify as a QDMTT. But CAMT is likely to be considered a covered tax on the Pillar Two, and on top of that, it is going to be a CFC tax regime, and therefore we would need to require the allocation to each foreign jurisdiction, whatever is going to be the calculation that is going to come out, and now we have to divide that tax up between what applies to the US, what applies to the foreign, and come up with some sort of methodology in order to push it back to each foreign jurisdiction for Pillar Two purposes. Like I mentioned on the slide earlier, the corporate alternative minimum tax is just a timing. You can pay CMT in 1 year, but get full credit in another year, resulting in a deferred tax assets. This could be a problem on the Pillar Two, on the Article 4.41e of the directive. Basically, we understand that deferred tax expenses related to tax credits is not included in the global ETR. And so what is going to happen in that situation is that we might be incurring a Pillar Two tax under the IIR rule that is not going to reverse. And now that becomes a permanent item for Pillar Two, where for U.S. tax purposes, the CMT has just been a timing and it flips around. If I had time, I would probably go through an example, but that is the issue that we have right now, is really the potential that the CAMT, because of the way it can be credited in a future year, that it can create some sort of Pillar Two tax, which could be an issue. So, what does this all mean? So now let's step back to my first slide, where we kind of really walked through that Pillar Two is not being addressed, but we have all these taxes in the US that we need to worry about. And how does this ordering of the US tax work with Pillar Two? So this is the way I think many of us have looked at it this way, where we basically the first step. And so think of it now as if you have a U.S. subsidiary of a foreign company, of a foreign parent, and the U.S. company has several foreign subsidiary underneath. So typical classic, what we call U.S. sandwich structure, right? The U.S. sandwiched in between foreign company, foreign parent, and your foreign subsidiaries. And so now think of it like, okay, I'm going to have to worry at the foreign parent. Let's take it as Belgium. So I probably have IIR in that situation. I might have some foreign subsidiaries underneath the U.S. that might be subject to the QDMTT. And then in the US, we have our US tax, we have GILTI, we have the CAMT tax. How does this all ordering works together? And so what you really start with is that you start with the QDMTT. So you start with the foreign QDMTT. That is the first part of the calculation. And the reason is because when you get into calculating your regular US tax, we believe that the foreign QDMTTs are going to be creditable against the US tax for purposes of GILTI and also for purposes of CMT. So that's why we put that as a first step that needs to be calculated. Then we calculate our US tax. And this is sort of like, for some companies, this can be tricky to separate the US tax from the GILTI tax. Our GILTI tax, the global low tax income tax, is not a separate tax that you will find on a separate form or anything like that. It is embedded completely in the US tax return. For some of them, it's going to be easy to pick out. But for some clients, it's not going to be. For some taxpayers, it's not going to be. And you're going to have to separate the US tax from the GILTI tax and make that determination. The next step is to calculate the CAMT, the corporate alternative minimum tax, if applicable. And then you need to separate, again, the CAMT, as we saw before, is is one calculation. And so we now need to separate the CMT between US, what applies to US, and what applies to foreign. Once we have that, we then need to allocate those US taxes to the various foreign jurisdictions, right? So we have GILTI tax that is going to be applicable to all the foreign subsidiaries that are underneath the US and make that calculation. And then we have to take we have to do the same thing for the CAMT. Once we have all the taxes allocated, where we have the QDMTT, we have the GILTI applied to the various, we have the CMT applied to the various foreign jurisdictions, now you have the ability to calculate the IIR at your, in my example, Belgian parent level, Belgian parent company, and calculate your IIR. If there would be not an IIR, then we'll have to calculate the UTPR otherwise. So that is a brief overview of what is happening in the US and how we think this might be rolling out. Like I said, I do not believe personally that at this point there is going to be coming out anywhere between this year or even next year around Pillar Two. And we might be stuck in this position that we just laid out for until Pillar Two will be live. But we'll definitely give you an update if things changes. Reach out to your colleagues who will be able to my colleagues overseas that will be able to reach to me if needed. Have a good day.